It's finally released. We have the Alibaba's earnings report released this morning. And CNBC says that Alibaba shares popped 6% after earnings beat. Finally, it's time for the struggling Alibaba investors. We've been so patient. We've waited for the nice day where the share price surges upwards, and we got it. Let's go ahead and check it because maybe it's popping even more than 6%. It's down to 1.6% on the day. This company, you can't catch a break with it. You just can't catch a break with Alibaba. The 6% pop this morning, unless you sold right at open, that's gone. It's down to 1.7% gains for the day. You can look at other stocks. We have Amazon stock here. This one is up 2% on no news. So Alibaba apparently beat their earnings report and they're up 1%, 1.5%. Amazon's just doing its thing and it's up 2.2%. So Alibaba investors, and me included in this pile, we can't catch a break on this stock. And I'm going to go over the earnings report. I'll try to give an unbiased take on it, even though I own the company. So I'll say what I think is good from the report, what I think is bad from the report. And I think what overall is the biggest thing that I misjudged when investing in Alibaba. I'll go over where I think I made the biggest mistake in my thesis. Now, another company that also reported earnings today is Crocs. I have a very small position in this company. I invested $2,000 in it, and the earnings report, in my opinion, does not match the market's reaction at all. The market's saying sell down 12% today. The earnings report is saying our business is doing fantastic, expected to grow, growing rapidly. We're making profits and free cash flow. Where all the metrics are moving in the right direction, right? Everything is moving in the right direction. The stock price is down a little bit today. It's down 12%. And I say a little bit only because this company is highly volatile. Over the past 5 days, it's basically flat. The past month, it's up 26%. So this one is one that it's incredibly volatile, but I want to go over Crocs earnings report because I think it's much better than what today's price action would leave you to believe. Now, we're going to go ahead and jump into all of that as well as my portfolio. Just a quick mention beforehand. If you haven't already, try out the FTX brokerage. It is now available. So this is out of beta right now. You can download the app or you can go on desktop, sign up. It only takes a minute. I have about $500 in gains in Amazon. I've been adding to this position. I'm currently in the green by 29% on this FTX portfolio. So it's done well so far. It's part of FINRA, SIPC, insurance. Go ahead and try it out and see what you think. Now, like I said, let's go ahead and jump into the portfolio and I'll show you my interest in Alibaba. I invested in this company. I currently have a holding value of $6,000. I'm $5,000 in the red. So I've lost 45% of my invested capital on this company. Hasn't been good so far. I bought it after a couple times, taking a leg down after earnings and a leg down after earnings. Now, in hindsight, everything looks obvious. Everything looks obvious looking through the window of the past. But the investment thesis for Alibaba was a very compelling one. The investment thesis is basically that it is a world-class, high-quality company that operates in online retail, fintech with their Ant Financial, and it operates in cloud. So 3 really fast-growing industries, and it's in an economy that was also growing fast. On top of that, it had some temporary concerns of regulations, and it had a legendary investor, who is Charlie Munger, buying the dip aggressively and stating that investors are panicking about Alibaba. The overall investment thesis is very attractive to a value investor. A severely undervalued company that is trading down in price because of temporary fears, temporary arbitrary concerns that will soon be forgotten, and the stock price will trade upwards to its fundamentals. That was the investment thesis. That's where I thought that I was buying when other people were fearful. And part of that thesis, I believe, was incorrect. I think I was wrong on part of it. The part that I think I was wrong on was underestimating how China's government would behave. See, I know that China's government is a authoritarian dictatorship. I realize that they don't have the same values. They run things differently in their country. But I thought at a basic level, at a very basic level, that they would at least value their most prized possessions, the biggest companies in their country, that they wouldn't want to destroy them, that they wouldn't want to destroy capital in China. And they have. They don't care about it. Every single action the Chinese government has taken virtually all of them. You can argue back and forth with this, but it has destroyed market cap. It has destroyed relationships with the US. It has destroyed investors in the US willing to put capital in these Chinese companies. They've taken away Ant Financial from Jack Ma's control, the founder of the company. The Chinese government now completely controls it, and they don't mind if that destroys the market cap value and valuation of Alibaba. So I knew that the government they're completely different than the US. I realize that, but I underestimated that they at least wouldn't have a common interest in wanting to prop up their companies and have their capitalism in terms of their biggest company succeed to a large degree. And I really think I got that part of it wrong. Now, when we get into this earnings report, I just want to highlight, I think, a couple of the key metrics here. First of all, we can go over the revenue and the earnings. The revenue of $30.68 billion was a little bit of a beat. So they beat by just a hair, but the revenue was basically flat year over year. This company did not grow from this year to last year at all. Zero growth in revenue. The earnings per share is down 29% year over year. So earnings are down 30%, revenue flat. That's the top and bottom line of the company. The net income was 22.7 billion won, which is about 3 billion in USD. So their revenue was flat, their EPS was down 30% year over year, and their net income was around $3 billion. Now they say in the quarter, and this is the reason for the flat growth, Alibaba faced a number of headwinds, including a resurgence of COVID in China that led to major cities, such as financial metropolis of Shanghai, being locked down. That led to sluggish Chinese economy in the second quarter of the year. This is something that we already knew about to some extent. If you consider the fact that I own Starbucks in my dividend portfolio, I have a big holding of Starbucks, that company has its second biggest market in China. And the Chinese sales year over year in the same quarter, year over year, were down 44%. So the fact that Alibaba was able to maintain flat revenue could be looked at positively through that lens. Other companies like Starbucks went down 44% in China, even though the overall business is doing fine. Their Chinese business declined sharply. Revenue from Alibaba at least stayed flat. It didn't go down. They also mentioned a cloud slowdown. Their cloud is slowing down rapidly. This is a rapid deceleration in cloud growth. It was only up 10% year over year based on this quarter. Last quarter, it was up 12%. And then before that, it was up 29%. So in 3 quarters, their cloud growth went from 29% down to 10%. These are not good things. You can try to spin this if you're an Alibaba investor. You can try to put a happy face on this, but it's not good. The company is struggling because of Chinese management of their economy, how they're responding to COVID. The cloud slowdown is severe. This is a severe deceleration. Now, additionally to that, it's even more concerning, particularly with the cloud business, that the slowdown isn't entirely due to economic conditions. They say the company's cloud division has been hurt by a loss of major customers as well. So they're losing major customers to competition. This isn't just the Chinese government shutting down China. This is also competition. So in summary, Alibaba posted flat revenue growth, earnings per share decline of 29% year over year, a net income of $3 billion. That's probably the most positive note. The cloud business is decelerating a growth rate rapidly, down to 10%, which is much lower than any cloud company in the US, by multiples, at least half the speed of any company in the US. And at the same time, the Ant Financial IPO, which was supposed to be a big catalyst for the Alibaba story, has now not only not been IPO'd, they canceled the IPO, but the Chinese Communist Party has also taken control of Ant Financial away from Jack Ma, the founder. That's the situation that Alibaba's in right now. Now, having said that, I want to go to an interview here with Kyle Bass. And he's someone that I brought up his concerns when I was first investing in Alibaba. He was very concerned about capital moving away from China because of the actions that their government's taking, saying that investors are not going to want to invest in China. They're unpredictable. They don't care about their companies. And I dismissed his concerns. I sided against him. He was right on this. He was spot on. I got this part of it wrong. So I want to listen to his updated thoughts on this, because basically everything he said regarding China around 6 months ago has happened. All of it has happened. So I want to see his updated thoughts on the situation.
I think it's important, Sarah, to note that if you listen to Xi's speech from last summer, He said it is his life's mission to, quote, bring about the rejuvenation of the great Chinese race, which is another way of saying they are going to annex Taiwan. And that is Xi's life mission, which he said he would be an abject failure if he didn't accomplish. So they are going to attack and invade Taiwan, whether Speaker Pelosi lands there or not.
Now, you can agree or disagree with Kyle Bass here, but the truth is this risk does exist. China does have specific country risk beyond just general regulations. I think regulations are fine, but I think there is risk of them doing something like annexing or potentially invading Taiwan. And if that happened, I think it would be somewhat similar, maybe even worse than Russia invading Ukraine. The situation would cause not only a ton of disruption and problems all across the world, but it would also cause, I think, investors in the US invested in Chinese companies to lose a lot of money. I think that'd be the outcome of it. So I don't know if he's correct here. There's no way to see the future, but this is a risk that you simply don't have if you avoid investing in China altogether. So overall, if you can't tell already, I have been more and more pessimistic and less overall enthused about the story with Alibaba. It's just been a disappointment. Not only China and the government and the regulations and taking control of Jack Ma, changing the business, fining them, removing the Ant Financial IPO, but also the fundamentals of the company, the slowing cloud growth, the deceleration there, a 10% growth rate, flat revenue. I just haven't liked the developments of this investment. And then on top of that, the situation has only gotten worse with Russia invading Ukraine. There's been more deglobalization. When Nancy Pelosi visited Taiwan, China considered it an affront, saying it was an insult that a US politician visited a close ally to the US. That's the situation that China's in. So I think there's more risk now than there was initially when I invested in the company before Russia invaded Ukraine, before all this deglobalization. And when I compare the performance on an individual security analysis basis of Alibaba compared to US firms like Amazon, it is remarkably different. So over time, I'll likely be phasing out my Alibaba holding. I'm not going to do it today, but when the stock has little days where it goes up a couple percentage, I might take some money out of it and move it into Amazon, move it into Google or Microsoft or Apple. I feel like those companies will have better risk-adjusted returns in the future. Now, having said that, I want to move on to another company that just reported its earnings, which is Crocs. And this company is also very cheap. It is a very inexpensive company if you look at expensive in terms of PE ratio. So if that's the way you're defining a company, Crocs has a low PE ratio, but it's also growing very rapid. It's a very rapidly growing company. Here is the second quarter highlights of it. The consolidated revenues of $964 million increased 50.5%. On a constant currency basis, meaning taking out foreign exchange, it was 55.6%. So they're growing at 55.6%, and they break this down by brand. They say that the Crocs brand grew by 14% or 19% on a constant currency basis. So that was okay growth, 20% growth in their normal big brand, the Crocs brand. But then part of this story is they just picked up a new company called Hey Dude, which I think is a great company. They have a very comfortable shoe, and I think they'll do a lot of cross-selling. This brand grew to $232 million in revenue in the second quarter, up approximately 96%. So their new acquisition, they grew their revenue 96% year over year. Then their digital sales were up 20% year over year. They say the operating margin was 30.1%, and the diluted earnings per share was a beat on top of the revenue being a beat. So they beat on the top line and on the bottom line, both the earnings and the revenue. Hey Dude's growing like crazy, and all of this is expected to grow in the future. Now, even with this earnings, which I consider to be really good earnings, the stock's down 13%. It's down a lot today. And you might be asking, Joseph, if the earnings are so great, then why is the stock down 13%? That's a good question, and it's because of their guidance. These stocks are trading off of the future, not what's happened in the past. And the full year guidance was lowered. It was lowered by roughly 30% or 30 cents. So they lowered it from $10.65 to $10.30. This is a fraction of a percentage. This is the big reason the stock's down 13%. It's really not that much of a guide down. This wasn't a dramatic guide down. The reason this stock is down 13% is partially just because it's a highly volatile stock. Over the past 5 days, it's up 1.5%. Over the past month, it's up 26%. So being down 10, 15% is not a big deal for this highly volatile of a stock. This isn't Amazon. This isn't Apple. It's not a $2 trillion company. This has a market cap of $4 billion. So if you're investing in a company like Crocs, you have to be comfortable with a lot of volatility. But that's my thoughts overall. I'll give another update as more earnings come out. We have Disney next week, and I'll give my instant reaction on that earnings report as well. So I hope you enjoyed the video, and I'll see you in the